Welcome back to the second installment to Know-How in Under 10 Minutes. We're talking about Put Call Parity part 2 again today. And today we're talking about pricing options without formulas. Who am I? Thorsten Roland Wegener. I used to be a market maker for options and retired many, many years ago as a partner from Bear Stearns in London. And I want to explain to you what is always perceived as a complex concept in easy terms. Assuming that there's a functioning market, you don't need Black Scholes, you don't need huge formulas. You actually can calculate the price of calls, puts in your head. And I'm going to show you now how. That's option basics. If you trade in options, you should know about this stuff. And I hope I can explain that to you in under 10 minutes. In the last video, I'm linking it in the top line of the screen. I explained to you what the put call parity actually means, that you can replicate one product through the other product. And the example I had chosen was simply, I want to be long the upside of a stock, I want to be short the downside of the stock. And this is exactly the same as if I would own the equity. I took the example and said, I have a betting slip, I'm betting to the upside. So if the market goes up, I'll make money. If the market goes down, I only lose what I paid for the betting slip. At the same time, I could sell an insurance to somebody else. So if the market goes down, I will lose money, and if the market goes up, nothing happens. I simply keep my insurance premium. So what you can see here, if the market goes up, I make money, and if the market goes down, I lose money, is exactly the same as if I would own the underlying stock, currency, share, commodity, you name it. This understanding should be clear now. And now let's see what interest rates do to this scenario, because that's what we didn't discuss in the last short installment. Here you can see the payouts again I had in the presentation for the first time. The plus simply means you make money when it goes up. The minus means it makes you lose money when it goes down. And the zero represents that it doesn't have really an effect. It's just a premium we are talking about. You add those up and you come up with the equivalent position in here. So let's start in a world without interest rates. I ain't paying nothing. You have the desire to buy a share. Beautiful, wonderful stock represented on the right. You want to go that long and it costs you $100. What can you do? You borrow 100 from the Bank of Evil, which I ripped off from the Minions. You spend this money and buy yourself a wonderful share of Apple stocks, and this scenario at the price of 100. And after you finished your speculation, let's say a year from now on, you obviously have to pay the money back for the return to the bank where you borrowed the money from, and you will have this money by selling the stock. If the stock has gone to 200, you have a nice profit. If the stock has a loss, you'll have to cough up the money somewhere, but the Bank of Evil wants their $100 back. And in a scenario without interest rates, to finance this position costs you exactly zero. All right, fine. Younger traders amongst you might not have seen that, not in the United States. In Europe, we had zero interest rates for a very, very long time. So it really happens. Banks were forced to get their money to reliable customers who could pay it back. Otherwise, they would have to pay a penalty fee for holding cash. But that's a different story. So what do we have here? We have seen the cost of finance for going to Bank of Evil, borrowing the money and returning it eventually was zero. And we've already established in the first slide and in the first little lecture that I can have the same equivalent position like owning a stock by being long a call, the betting slip, and being short a put. I have given insurance to somebody against this. So if these products have the same payout, you make exactly the same money on both sides of the equation. The market goes up, you make exactly the same amount of money. If the market goes down, you lose exactly the same amount of money. Can they have a different price? No, they can't, because otherwise arbitrageurs would come in, would sell the one, buy the other, and they would do that so many times until the price eventually evens out again and you arrive at this relationship again. Yeah? In this scenario, you can see something special. As I've chosen the example with the price of the share at 100 and the call option, the strike price at 100, and the insurance policy, the put option at 100, we're exactly at the money. So in this scenario, you also see if the cost of finance is zero and the price of the call put combo has to be zero, then the cash flow, meaning the money you pay for the call and the premium received for the put, has to be equal. They have to add up to zero in a world without interest rates. So, what happens now in a world where we have interest rates, the more likely scenario? You want to go long the stock, you do the same thing again. You go to Bank of Evil and say, I want to have $100. You spend this $100, buy yourself a wonderful Apple share, but Bank of Evil has given you the condition they want 105.5 back. Where's the $5.50 coming from? That's the cost of finance. In a year's time, in my example. But these costs of finance, we have to look at it in today's money. Yeah? So $5.50 in the future are today only worth $5. That's how you approach it properly. The cost of finance is calculated in today's money, and in this case, that would be $5. So we can come to the same equation again. Now we've established the cost of finance for the stock on the right is $5. So the price call put combo has to be $5 as well. So what do we see here? We don't have a price for the call or the put, but what you will see in the market, you only need one price. You see the call has a price of $10 on there, and you don't see a price of the put, but you know the put has to be worth how much? Cost of finance has to be $5 for the same equivalent products we have here on the screen. I pay 10 for the call, so I have to get an insurance premium of at least 5 to have exactly the same price call put combo, the $5, the cost of finance for this share would indicate. Otherwise, you can open up an arbitrage again, and that's what market makers take advantage of, or provide you with a fair market. Same scenario here again, different prices now, could be different stock. The put is worth $10. You don't see a price of the call on the screen, but we can calculate that. We know the cost of finance is $5. We know that the price of the call put combo necessarily has to be $5, which means I will have to pay $15 for the call. If I can pay less, I have locked in a safe profit. This would be an arbitrage. Then I would have bought the share $1 cheaper than I would have could sell it at the same time. Classic arbitrage, but I can see now on what if I have two prices. I have the price of the stock, which you will have most likely on the screen, and I have only one part of the option. I can calculate the price for the equivalent put or call out of this. In the first lesson, in under 10 minutes, number 1, when I explained to you the put call parity, we started with owning a stock. And then we said, fine, the cost of finance now we've established is $5 in today's money. If I would buy a put and insure myself against adverse markets, I would have to pay money for that. In this scenario, it's $10 I have to pay. So I own the stock and I own the put. I own the insurance company, the insurance policy this time. So whatever happens to the downside doesn't bother me. Market goes up, I make money. Market goes down or stays where it is, I've only lost the premium I paid for the put. We knew that this was exactly a call. Now we simply say, what's the cost of finance for the share? What's the price of the put? We know the stock plus the put is $15, so the call price has to be $15. And there you have it. You don't need Black Scholes. You can do it on the screen. And I'm going to show you in the next short what we're going to do with that when we introduce different strikes, and also show you then the dividends. This time the dividends I've only put into the cost of finance. Interest rate costs you money, cost money, and dividends bring in money. We can net this. And in the next short, I show you a trade forensic of one of my students who forgot this relationship, and that's getting a little bit more complicated, but you have 2 more sessions till we see that. I hope you enjoyed this little scenario, how we incorporate interest rates and can see prices on the screen, which I'm eventually going to show you as well. How does it look on a real trading screen? I hope you enjoyed that. Thank you very much. See you soon. Bye-bye.